we're live, but we're going to give about 30 seconds here for the people watching live today to get connected. Well, I'll tell you, whenever you don't know what to talk about, you usually talk about the weather, right? So let's vamp on the weather here for 15 seconds. It is amazing outside. Have you been able to get out and enjoy this weather? Or have you guys been too busy doing refinances for people?
No, we sit out on our back patio every night, and it seems like this fall we may actually get a fall. You know, I think last year it was hot and jumped right into it. I don't know. In Texas, you get less and less snow and more, you know what I mean? The weather's not like it was when I was a kid.
Well, it's glorious out there. Well, look, let's go ahead and get started. Lori, it's great to have you with us. Lori Anderson with Thrive Mortgage, and we've known each other in the community here in Georgetown for a number of years, and we've had some professional experiences with you, and so I'll tell you, Lori, I've been doing this a long time, going back to 1984, and I can't remember a year where I didn't have at least a couple of conversations with somebody we were working with, and the topic of should I refinance my mortgage come up. And it's funny, back in the early 80s, rates were low if they were like 7 and 8%. And today, of course, we're looking at a whole different universe when it comes to interest rates. But we really like to focus on basic topics on these Wise Counsel live discussions, as well as advanced topics. But today is such a timely one. We wanted to really dig into refinancing. And rather than Zach or Sydney and I giving our opinions on how this works, who better than somebody who's in the trenches every day doing these deals for people? And I consider you an expert in this area, and you're one of my go-to sources whenever we've got mortgage questions. So thank you for making some time with us today. Before we jump in, just tell us briefly about yourself, kind of how you got into the industry, and a little bit about Thrive Mortgage.
Well, I kind of got into the industry a little bit. I think it kind of fell in my lap. I've never been able to have to go out and job shop. I was always in banking and have been in banking my whole life. I've been in Georgetown since '94, and I worked at a local bank. So I've worked at a local bank and some big box banks. Mm-hmm. And of course, when you walk into, the big box banks and the community banks, it's different and different types of lending. And I came on with Georgetown Mortgage, now Thrive Mortgage, and we just had a name change because we've been growing so big about 4 or 5 years ago. Been with them 9 years. And so when someone asks me how I think I'm different, I basically just tell them because of my background, because I've been lending at community levels, at the big box bank levels, at all sorts levels, and now at a residential level, had a little bit of commercial background too. I get a lot of unusual circumstances thrown my way. I can do construction lending and things like that when someone wants to build a home. But you're right. Right now, it's all about refinance lending with these low rates. And that's what I think that I've been doing it 9 years, and I'll never do anything else or leave anywhere else, because I finally found this is just, I love what I do, and feel very, connected to some of the situations that I run across.
Yeah, well, I know Roy and Barbara Jones, the founders of Thrive, originally Georgetown Mortgage, great people, great culture there. And so it's just another great success story in Georgetown. Gosh, I don't know, you guys are nationwide now I don't even know how big y'all have gotten, but it's been a real amazing thing to watch that grow over the last 15 years. Let's get into this refinance thing. I mean, tell me if I'm off base on this, but I'll just kind of tell you how the conversation might go. For example, hypothetically, one of our people we work with, they might say, hey, Bob, interest rates have come down. I'm thinking about refinancing. What do you think? You think I should? And usually what I'll say is, well, I ask them what their current rate is, and I'll have some idea of where rates are today. And I say, well, look, if it's at least a 1% potential drop, you've got a real conversation worth having with somebody. There's a lot of other factors though, but yeah, I think, if that was the case, then yeah, it's worth taking a look at. You do these deals all the time, Lori. What would your reaction be to that? Is that an accurate way for me to kind of give them a set of expectations, or is there more to it?
No, you're very spot on. But there are other questions that I'll ask borrowers, because there's a lot that kind of comes into play on your decision making. You know, and rate is always the, you know, number one thing that comes out. But then some people are very sensitive to cost. They're not as much rate sensitive. They're sensitive to cost. And then some of them are real sensitive to the monthly payment. So it's kind of what drives them. And it also then, I think, depends on the experience level of the borrower, of the client. Are they somebody that's first starting out in life? Are they somebody that's in their 30s, they're raising a family? Are they somebody on the back half with empty nesters? And what's important to them? So I always ask a lot of questions, but what type of things do you see? I mean, when people ask, do you see people in that all rim of that looking for either, or do you see mostly people that are wanting rates, that are talking rates?
Yeah, usually the initial interest is in rates, right? Because they see the rates quoted online or whatever, and they don't really know where to start. So they usually just want to get our opinion initially, and but then it gets down into the weeds a little bit, and most people out there have probably had the exciting experience of responding to one of those online sites that's offering low rates, and then all of a sudden you get calls and texts, and you're barraged by people trying to help you. So once you've experienced that joy, usually you tend to stay away from that in the future. But we always recommend that they get with somebody who is going to be transparent and professional and competitive, but not necessarily the cheapest rate out there. It's true in all things. You get what you tend to pay for. But you guys have always, from what I've seen, been very competitive, and you've always been transparent and given us good answers when we've been involved in these kinds of transactions. So, you know, I think it's great to work with somebody who's a pro and not just somebody on the internet. That's been my personal experience. So let's get into this a little bit. I know you wanted to kind of walk through some of the nuts and bolts of a refinance. I mean, let's just make an assumption that somebody has a good enough credit rating. I don't know if you want to comment on that or not. That's up to you. But let's say they're okay there, and you know, they've got plenty of equity in their home, and they're looking at a refinance opportunity potentially. So that's great. But you know, what happens? They contact you, and then, you know, how do you help them make the best decision for them?
Well, initially what I'll do is like I said, I'll ask a lot of questions. You know, how long have you owned your house? How long do you plan on owning the house in the future? You know, is this house, you know, are you going to be selling it in 2 years, 5 years, 7 years? Do you even know? We always ask them what type of mortgage they had before. Did they have a government mortgage with an FHA or a VA? Or did they just do a do a purchase with a conventional loan? Because that makes a lot of difference. And then I'll always ask them what is motivating them, what is important to them about it and that's where I kind of can see, is the person more trying to lower their monthly payment, or are they trying to just save money for the future? Or are they trying to just do what's best financially, big picture? And part of the time when you talk with the borrowers and the clients, you don't really, they don't, it's kind of like when you go in to see a doctor, and not that I would compare myself to that, but some people don't give us time to really dig in deep on that, on their refinance or their purchase or this is their primary home. And you really need to think about what's going to be best for you and not just take some of these decisions out there. Because the other thing that I have found a lot of times is some of the other companies out there is you've got to make sure you're comparing apples to apples when you're comparing out interest rates. And that's where I've prided myself on some of my background. I want to make sure that the borrower or the client understands what they're getting and how the difference to that is. Because to a mortgage lender, cost and fees and rates, it's the same pocket for us. And that we can talk about that in a minute, but it's the same pocket. So what is motivating the borrower? They want the lowest rate. Do they need a no cost or low cost mortgage, or how do they do it? And one of the things that I like to do is a total cost analysis for a borrower. I'll stop there and let you have any comments on anything just before we show any of the screen up. But I mean,
yeah, no, I'll share this first image for us to walk through, but I'll tell you, I guess it's one of the things I like about working with you guys, Lori, because what you were just describing to me, what I heard you saying is that this isn't just a transaction. There needs to be, you need to think about the bigger picture here. And of course, that's what we do for a living around here. We're planners. And so that we might know that they've got some high interest debt over here that could be wrapped up into a refinance, or there might be a need to do a cash out refinance. I mean, there's all those kinds of things. Maybe we'll have time to get into some of that later. But you're absolutely right. It's not just, what's your rate? Is your rate lower than the other guy? I mean, that is such a superficial thing. There's a lot of moving parts here. So thanks for sharing that. I'm going to share this image and then just kind of let you walk us through what you want to point out. Obviously, you've got some things highlighted here. Go ahead.
Well, a total cost analysis is basically taking your current mortgage and comparing it to 2 or 3 different options and analyzing that. Because something that's very important is when we go out and we get an interest rate and we're going to go shop the market for whatever interest rate is out there for today, that interest rate market may be in this instance, maybe 2.75, and that's market rate. If you want to buy that interest rate down, prepay a little bit today at closing, you can get an interest rate below that. But is that smart? And if you're also comparing lenders out there, they might offer you 3% and give you a lender's credit. But unless you understand and you're comparing apples to apples, you really don't know. And that's what this tool that I use does for the borrower. So if you're looking at this specific example, it's a hypothetical situation of a borrower that has a 283 mortgage on their house. They're at 4%. Yes.
The first column here.
First column, vertically. Mm-hmm. So they are about 5 years into a 30-year mortgage. If you go down to the very part, it says freedom point. So they're 5 years into their mortgage at 4%. Now you automatically think, okay, 4% down in the twos, let's refinance. Mm-hmm. And so, but you have to really kind of dig into that, especially if you're out there looking at other lenders. Someone might offer, 2.75 or 2.875 or 3%, but you've got to understand what the fees are, because to a lender, like I said, it's the left pocket or the right pocket that we're going to do for that. And that's where I let my borrower have a little bit more control, and I'm a little bit transparent, where I'm like, okay, you tell me what's best. So what I've done in this situation is I've compared a refinance for him, and I've given him 3 rate options. The second to the left column is 2.75 to 2.625 to 2.5. Mm-hmm. And so basically you can see that his payment difference, if you look at his payment difference, it's about $20 a month difference, but you've got to come out of pocket $2,000. So what you want to do, Mr. Customer, Mr. Client, is let's look at this, and you're looking at a difference of $20 a month, but you're having to pay down or buy your rate down for that for an additional $2,000. What's more financially what you would think would be the best thing you'd want to do? Mm-hmm. If you go to the other one, Bob.
Yeah, before we leave this one, let me just make sure that I'm tracking along with you here. So we've got option 1, option 2, and option 3, and basically they're all the same refinance assumptions except for the interest rate, right? And so you've got one at 275, and you got another one as low as 2.5. And so you look down the sheet here, and when you were talking about $20 a month, you were talking about the difference in the $21.37 a month versus the $21.17, and if they went even a little bit more. So people would look at that and they would say, well, that's not a huge difference in a monthly payment, and is it really worth the out-of-pocket expense, right? And that's right. The second line you highlighted here is that's how much more you'd have to pay. Is the only difference there pretty much, Lori, the fact that they're having to buy down the rate a little bit lower? Is
Yes.
that the main reason that those costs go up?
Yes.
Okay.
Now, let me kind of step back a little bit. Is in some situations, you've got clients in VA loans or government loans, or you maybe have a client that has mortgage insurance.
Mhm.
And that's what this is going to do, is take their current situation and kind of compare it out and see where the costs are hitting you and where you're saving, so that you can be able to see, that he's going to be able to save $280 a month in this, or $260 a month is what he's going to save monthly for that. And this example is kind of a simple example, but sometimes they can get very complex depending on where they are or what they're wanting to do. This guy, for instance, also has 50% equity in his home.
Mm-hmm.
And so he could then go off and pay off debt at 16, 17%, or pay off a car when you can borrow money at the low twos. But then, of course, you're also then adding it to a mortgage for 30 years. So there's ways that you can look around that to decide whether that's what is the best situation for you.
Well, and if I was looking at this and I had no other information, let's say I'm the consumer, and I look at this and I say, all right, if I just go with the market rate and I go to closing and it costs me basically nothing to close, I'm saving $260 a month all in, but I could save another $40 a month. So 40 times 12 is $480 a year of additional savings, but it costs me $3,800 to get that. So, I'm looking at about 4 years before I get that money back, right? So that's a simple way to look at it at this point. But then the next one, I think, takes it a step further and looks further out. And I think this is where you start to look at kind of like future total savings, another way of looking at this, right?
This is the same hypothetical situation, but if you look at the bottom 2 to 3 lines, if you look at the total cost of the refinance there, what you're doing is you're adding the interest at the potential new interest rate plus certain fees that are tied to the loan.
Mm-hmm.
And so if you look at it, you actually see that you save the most money by going with the market rate, because
right.
you've got for in closing costs and points and things like that, the column over here at 2.5. And that's what I guess I want people to say, to walk away with. It's not all about rate. It's
Mm-hmm.
about what you want to do and what your goal is. If your goal is, because we could roll these fees or costs into the loan, up the loan amount,
Mm-hmm.
and he'd be out no money. But what's the long-term effect and what's going to be smartest for the borrower? And in this instance, they always think, oh, rates, I got to call around to 6 people till I get the lowest rate. Well, compare those rate options and let's see. Now, I am going to say one more thing that's kind of a little bit off, but you go out there to, I can search 20 or 25 investors, Bob, okay? And I'm looking for a refinance, and I'm looking for maybe a 15-year, a 20-year, and a 30-year. Well, whatever that investor needs in their cupboard, they have a hole in their cupboard of portfolio lending, they're going to price that loan to be that way.
Mm-hmm.
And I priced a loan out yesterday where a 20-year was higher than a 30-year. So that lender wants 30-year, not 20-year.
Mm-hmm.
And 15-year was a little bit lower, but it was just, people just have this perception. So in the instance that you happen to start your refinance with your mortgage loan officer, well, you never know what's going on with the market, the fee, the economy, things like that. And so sometimes it's not always just cut and dry that you're going to buy down, buy down, buy down. They may have an enormous fee out there, or the cost to buy down that rate at 2.5 may be more than $3,000 because of what their portfolio and their strategy for the next few coming months.
That's interesting. I don't know if you can answer this or not, but you mentioned a couple of times when I go out to my lender, just at a high level, who are the typical sources as lenders? Are these institutions? Are they, private pensions? What are these? Just help me understand that, because I don't think I've ever asked you that.
Well, when you walk into your local bank, mm-hmm. that bank has a lending policy and it's internal portfolio money. They're keeping it in their own portfolio lending. The type of lending that I do is Fannie Mae, Freddie Mac, and it's mortgage-backed securities, and it's what you see that changes day in and day out, day in. And so you can go to Chase Wells, you can go to, you know, these big box banks, but then you can also go to your online lenders. But then somebody like me, we're a mortgage banker and we lend on our own money, and then we can sell straight to Fannie Mae. So you're looking for someone, that's a question when you're interviewing looking for a mortgage originator, you ask those type of questions. Tell me what type of lender you are and what type of options you're going to look at, because some of them don't have the options and some of them are wholesale lenders versus that. And so it just depends on who you are and what you're looking for when you're trying to interview and find somebody, because that's the other beauty of it, is some of these places, they only have one or two options that you can look at, and they are order takers. And so they're paying them to take orders instead of trying to help you make the best financial decision and understand what's going to be best for you. They're just trying to put them in. And I'll tell you this right now, Bob, we normally close as a company between 400 or 500 loans a month. Since COVID hit, we're now up to 800 loans a month, company-wide, that our team is doing. And so it's we're working on our 7th month of this. And it, just use somebody that you trust. It's like you said, it's not always the cheapest. Use somebody that you can trust that'll shoot you straight.
Well, we've certainly heard some bad stories. I've learned that personally over the years. You know, find good people, and then you know, you don't have a lot of surprises when you do that.
Mm-hmm. Mm-hmm.
Okay, well, we've got a little bit of time left. I thought I would kind of throw a few questions at you, stuff that comes up. Some of this is really basic, but there might be somebody listening to this that would like to know. We hear sometimes about jumbo mortgages. Just in a real short answer, what are the limits, and why does it matter if you go over the jumbo or under the jumbo?
The limit is 510,400. They've upped that limit recently.
Mm-hmm.
And the reason why it matters is because Fannie Mae doesn't get involved on those loans.
Okay.
So when COVID hit, all of that money kind of dried up, because those banks were in a situation where they were wondering about their own liquidity and things like that. And now we're 6 months into it, and now it's opened back up a little bit. Not every lender that we had in the past is back, but most of them are back on that lending, and the rates are silly good on that type of lending too. But I think it's because they had a break there, you know, of trying to regroup, and they're even stronger. But that's what makes it is they're not a Fannie Mae booked loan. So then you go to the investor, and the investor is putting different guidelines on that, and so it's just a typically underwritten a little bit different.
So is it true in a normal market with normal equilibrium out there, would you expect to pay a little higher rate on a jumbo mortgage?
Mm-hmm.
You would. Okay.
Mm-hmm.
What have you seen in the past? How much more above market rates is reasonable to expect?
Whereas like in this instance, you're seeing in the mid to high twos. You might be probably, if they wanted to buy their rate down, 2 to the low 3s. It's not a big jump.
Maybe half a percent, half to 3/4%.
Yeah.
Okay, well that's all.
And they also have a lot of these jumbo. I'm actually was looking at jumbo rates just 2 days ago, and there's also a market for someone that they look at debt to income ratio, liquidity, and reserves a lot more heavily than they do at these conforming loan limits under 500,000.
Okay. Couple more questions before we run out of time. If somebody has like the example you were using here, a home worth $500,000 and maybe they've got a $300,000 mortgage. I've always been under the assumption if they wanted to do a cash out refinance, maybe they need some extra money to go pay off some other debt or whatever, that generally they could expect to get up to about 80% loan to value total. So in that case, that'd be about another 100,000, give or take, with closing costs and all that. Is that still a pretty good rule of thumb, 80% loan to value to be able to do a cash out refi?
If it's a Texas loan, it's 80%.
Okay,
yes,
that's
sir.
good to know. That's good to know.
Now, let me tell you this though, Bob, is whenever you are going out and pricing somebody and you're doing a refinance, they have something called loan level pricing adjustments. So in an instance where a borrower's got 50% equity, they may have a better rate than someone that's got 80% equity.
Okay.
And so it's again,
20% better than somebody who has 20% equity.
20% equity. That's what I meant. 20% equity, because
makes sense.
And what it does is because
less risky loan. Yeah. Yeah.
Yeah. And so everybody thinks that they can just call up and get a rate, but there's these level pricing adjustments, debt to income, property type, how much equity they have in it, all of these things and that changed when the economy went tanked in 07 and 08. They changed how they price all this out to make it more fair. And so you can't always compare your rate to your neighbor's rate. You just can't.
One other thing before we land this jet. I remember years ago, property mortgage insurance, at the time, I remember it only being able to be added in if you needed it, if you had less than 20% equity as part of your monthly payment. And then it was a hassle because once you got down to 20% equity, you had to go out and get a new appraisal and expenses and all of that. But from what I understand, that's changed now. You can just pay a single fee at closing, or just explain PMI a little bit and what has happened over the years and where we're at on that today.
Mortgage insurance, private mortgage insurance, is if you don't have the 20% down payment and you want to get into a house with as little as 5% down, you can buy what you're in essence doing is getting a insurance policy for the lender to cover that shortfall. But you're right, back in the day, it was only a monthly premium. Now you can price that out one time up front, or you can do a split and do a little bit up front and a little bit monthly. And what that's doing for the consumer is drastically reducing the cost of that.
Yeah, because you don't have a monthly payment forever, and you don't have the extra expense to come back and prove you've got equity now to get rid of it.
So you basically are paying, most of the time, if at 5% down, you're paying that mortgage insurance for 7 or 8 years. And if you take that premium over 7 or 8 years versus the one time up front, and it makes a difference. And we do a lot, probably about a third to, well, probably almost a half of what we do is that, because it's so much smarter now. Yeah.
Okay. Well, look, I didn't know if we were going to need 30 minutes for this discussion today, but I could keep going another 20. I've got other questions, but we need to wrap it up. We've got a couple of minutes, and I want to give you a chance before we go to share anything else you want to share, but also tell everybody one more time if they're interested in having a discussion with somebody who will shoot straight with them on this stuff, how to reach you. So any last comments, and then tell us how to reach you.
The thing that I will tell people, Bob, is if you've got a quote from another place, I will look at it and I will not feel hurt if you don't use me, because I want what's best for you. And I get that from my years of banking, and I honestly, truly will do and give you the straight on it. So, because I feel like if I pay it forward that way, then eventually things, you're going to have some trust in what you're doing and that type of thing. And that's what I really pride myself on, is that, let me see it. I'll tell you whether they're raising this fee to offset this fee, or if they're charging you, this, and they say it's no cost and it's really not no cost. Well, it's because of this. And right. I'll give you that straight skinny and be honest, and I will not have my feelings hurt if you go somewhere else, because again, I just want what's best, and I want you to feel comfortable in what you're doing, and that's just going to make us all better.
And these days, that just reminded me, these days, you're working with people all over the place. They don't have to just be local. It's really, in fact, a lot of times, even if they are local, you never have to meet with them in person, because everything seems to be done online these days. So
I'm licensed in 6 states.
Okay. All right.
I'm licensed in 6 states. So just call me, and I can
give it. Let's wrap it up there. Give them the best way to reach you if they want to reach you.
I just say my cell, 512-577-7930.
Okay, great. Well, Lori, thanks again for being with us today. I always learn something when I talk to you, and I appreciate the fact that you're good at what you do. Have a great day, everybody. We will see you next week. Lori, have an awesome day. We'll talk to you soon.
Appreciate it.
Bye-bye.
Bye-bye.